What's good, guys? Just wanted to essentially break down the most recent reel that's going to be getting posted tomorrow on IG and just kind of expand a little bit further on it. Basically, talking about the three main types of inducement. There's actually a fourth one that I'm just thinking of right now. So, what I'm going to do is talk about how to look at these, just obviously from more of a black and white perspective. Obviously, these things don't necessarily work out identically on the charts. There's some room for, or some margin for interpretation when it comes to liquidity concepts, and it's a big part of the reason why we sort of introduce them day to day as opposed to in these raw and uncut schematic sort of formats. But this is going to be the first of many different videos on the different liquidity concepts that we sort of teach within the actual curriculum. And yeah, let's start with inducement. I think it's one of the most important ones. So let me just grab my drawing tool. So essentially what I look for, there's three main types. There's this one right here, which I like to sort of refer to, and I'm just kind of obviously spitballing ideas between names, but this is what I like to call like a mitigation inducement, where essentially what's happening here is you're going to see some built up tighter mitigations that happen deeper in price or higher in price in the bullish leg. And what usually ends up happening is you'll see some form of a sweep or an aggressive order flow shift from likely some unmitigated supply to the left, which will usually cause people to start looking for trades here, which also leads us into another type of inducement, which would be structural. So before we get into that, like I said, it's basically this contraction in price, very efficient pricing that's happening higher up in the leg that typically will get swept and then ideally take out the level that initially got mitigated, which is over to the left-hand side here. So that brings me into type 2. Type 1 was, like I said, the built-up mitigation or mitigation inducement, where we're essentially just a liquidity grab, tricking people onto the wrong side of the market looking for supply trades, when all the while we're looking to essentially build, take, and then continue on our merry way. So getting further into this, the next one I want to talk about is this area right here. First thing every single person that gets introduced to smart money looks at is we see a higher time frame POI. We get the initial tap in, we get a 15-minute change of character, or an order flow shift is kind of how we refer to it within fractal markets. So once we see this, the immediate reaction to most people, again, that are a little bit newer to smart money concepts, trading supply and demand, first instinct is that we're going to trade from this level. Obviously, as you progress through our program, you're going to start to see a lot more of these liquidity concepts in real life. And most people know that the initial tap that we get into a POI will typically get swept. We'll get interaction with it to build liquidity to mitigate deeper into this POI. Again, this is almost a picture perfect example of this. They don't necessarily always happen this exact way, but one way, shape, or form, it's basically one and the same thing, these structural sweeps, right? So initial tap, what you really need to get from this is that we'll get the initial tap into a pivotal point to create this higher time frame trend reversal. And essentially what ends up happening is once we sweep this high, what will typically happen is most people want to start trading here, right? Because they think it's going to continue higher. They've got taken out on these sell orders over here on the structural sweep. And then what ends up happening is now they're getting induced again to come down into these levels. And now what they're doing is they're chasing price around and not knowing where to go. And I mean, really the definition of inducement, and I don't quote me on the exact wording, but it's essentially a back and forth trickery to getting you onto, in the context of a Forex market, to keep you on the wrong side of the market. So, where am I here? So we've gone over mitigation, which usually happens higher up in the leg, built up mitigations, sweep, come back up. Okay. And then we have the structural, which is my type 2, type 1. And getting into the last one, this is kind of like my newest one that I really, really like playing, is I like to call this the sweep the flip. I'm looking for a better name for it, but that's my corny name for right now. So as most of you guys know, anytime that we're looking to potentially get involved with a trade, there's our infamous LTT theory that seems to be getting tossed around all over the fucking place now, which is, it is what it is. It's a great theory, and it works really, really well. And this is all built around inducement, which is one of the primary functions of our trading plan. So if you look at this as a flip, right, one of the main things that you'll notice here is that this, of course, depending on what time frame you're on, and this is obviously a very perfect example, first thing you'll notice is that there's no take on liquidity here, right? So what ends up happening is now maybe people are thinking that this is a boss and that this is a strong low. So they start trading here, they come up into here, they move over to break even. All the while, they've missed that the order flow shift has happened, and now we've generated this single point of liquidity known as the sweep of the flip to be able to get you into the deeper portions of the initial reversal pattern that's happening. Again, just need to shed some light on this to make sure that everybody's on the same page, but this is not how things frame up perfectly in the market, and that's the whole reason why we show these examples day in, day out, as opposed to showing you a black and white formula and saying, have at her, this is how it works every single time, because quite frankly it's not. This is how an optimal setup would frame up. Okay, so induce would basically be, okay, well, here we go, we come down, people are looking to trade here, right? People are looking to trade the flip. Why? Well, because most people are taught that flips are reliable and so are extremes, right? But if you miss the flip and then this happens like this, what are you looking for? Well, more than likely, you're probably already on the wrong side of the market looking down here. You're not sure what to do. Now you're doubting it. So now you see coming back up. You think it's going to sweep again. But meanwhile, this high is already strong because it's taken liquidity and it's broken structure, right? So all this to say that basically this flip gets ran as inducement or liquidity that sweeps up into this level. Once we get the initial tap in, what do? Same thing as we did right here, right? Initial tap into the POI, right? What happens? We get interaction. Interaction's right here. Just go like this. Again, on a lower time frame, this would be a lot more clear. So interaction right here, right? Interaction right here on the initial break. Once we sweep up, what happens? We break down, and then we come back up, then we come back up. Same thing, looking to lower confirmation, enter here, and ultimately induce these guys down here. They're looking at this as a change of character. Boom, they're missing this, and ultimately we're taking all their liquidity pool that's resting underneath here. So that's type 3, and again, so this is called sort of like the sweep the flip. This is a structural liquidity sweep, which is structural inducement. This is built up mitigation, demand mitigation inducement. And then we have, of course, on the flip side of things, we have an interaction zone that happens here. Maybe there's a smaller take on liquidity on a lower time frame, but we have supply chains sort of compressing as we get deeper and deeper in price. Of course, the deeper and deeper we get, the more likely for a pullback. Where do we need to essentially see orders get taken from the market? Well, ultimately, in order for us to continue taking out levels and levels and levels and levels, oftentimes what's going to happen is when we start to see this very efficient pricing, we're actually going to see these orders in the short term overturn the amount of orders that are resting below here, right? So because of actually how illiquid the market is and how little orders there are to fill down here, and there being more orders to essentially fill above these highs, the market will very abruptly sweep into here, causing people to trade here as a change of character, and this is known as change of character inducement, and it's all one and the same thing. They all stem from a liquidity sweep, but understanding how these things happen and when they typically happen within price is ultimately how you're going to get yourself onto the right side of the market, and how to be patient and wait for these bigger liquidity sweeps to basically stay involved with the higher probability moves. So just a quick recap, type 1, right, is mitigation, liquidity sweeps, okay? Inducing mitigations, boom, boom, okay, into a very specific zone, okay? Type 2 is going to be a structural one. Now, that's essentially when we get the initial tap into a POY. Typically, we get some form of push down, and then we get interaction here, sweep up, get people trapped on the wrong side of the market, and taking out the structural high, causing people to think that there's a strong low. All the while, order flow has shifted and taken liquidity that rests above here to be able to fuel this move to create liquidity for type number 3, which is the sweep of the flip, to be able to get yourself into a state where liquidity is taken for one last time through the market. It's created its own liquidity at the high, order flow shift, realignment, lower time frame confirmation. Look for this exact same schematic to happen here, 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 all of these places. It's the same fucking thing, day in, day out, rinse, repeat. It comes in all shapes and forms, but the theories remain the same. So that's it on my little splurge on inducement. I hope you enjoyed this. Give me some feedback in the Discord if you liked it and if you want more content like this.